They are panicking. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, we have a presidential predicament as the next crisis is unfolding at the White House. And I want you to understand why the Biden administration is so worried, because when we look at the state of the consumer, the average American, they think the economy is doing quite well all of a sudden, and I'm going to show you why they've got it completely wrong. And it'll make perfect sense why we see the moves by the White House right now are because they're in full crisis mode. Now let's over to Goldman, where we picked today's story up with a headline: incumbent U.S. presidents tend to win elections, well, except during recessions. And this is a big problem for the Biden administration, because if we've looked at on the show, the global economy is slowing down. But all of a sudden, the narrative has changed. The equity markets here in the U.S. are breaking out to new highs. Consumer confidence is rising. So does this mean that we have actually now achieved the mythical soft landing? Or do consumers have it all wrong? Because when we look at what the White House is doing right now, you can sense they have an absolute fear that a deep recession will be here just in time for the elections. And it makes sense, because if we look at U.S. incumbent presidents, this according to Goldman Sachs, they typically win elections outside of recessions. And here you can see incumbent party electoral vote margin. Well, that during recessions does not look pretty. Now, this takes us into our headline, because I want to look at what's going on with the consumer first, as we see improved inflation views lift U.S. sentiment to highest since 2021. Now, from the consumer perspective, this is great news, because why do you see consumers get more confident is when they see inflation come down, their wages hold or rise, where they think they're starting to get ahead. And this is great news for the U.S. economy, because on the surface, when consumers are confident, well, what do they tend to do is go out and spend. And if we were indeed achieving this soft landing, well, there would be no reason for the Biden administration to start to panic. The problem is they know this isn't going to last in time for the elections. The University of Michigan Consumer Sentiment Index rose 9.1 points to the biggest monthly advance since 2005 to 78.8. The preliminary January reading was out Friday, stands at the highest level since July of 21, surpassing the most optimistic estimate by economists. And I'll show you why that is. Now, combined with a drop in year-ahead inflation expectations. Now, this is really important here, because again, as long as U.S. consumers feel that their wages are safe and inflation comes down, their confidence begins to rise here. This is important to understand. And of course, these expectations of inflation have dropped to their lowest level since the end of 2020. This turn gives a spike in confidence, has the potential to sustain demand and keep the economy on its expansion path. This is something, of course, we know political elites are going to be looking at. And of course, those central elites at the Fed, they're going to be talking about this at the end of the month in January, that all of a sudden confidence is rising. This means, of course, people go out and spend. Brings inflationary pressure, gives, of course, the Fed now another excuse to keep rates elevated and not cut. More on that in a bit, as more sanguine views about the inflation rate may also reassure the Federal Reserve officials they could consider when to begin lowering interest rates. As we've noted, the market believes it's going to be in the first half of the year. Fed says not a chance. It's going to be in the second half. We're going to make the case now why the consumers got this all wrong, why the Fed's got it wrong, and we'll see here in the data. It's very clear, because let's talk about what this means on the surface. Again, is when you see confidence rising, as we look at the University of Michigan Consumer Sentiment Survey, that's shown in blue, and we're going to overlay the advanced retail sales data in red. That one on a year-over-year rate of change. And when you see confidence rising, well, it makes perfect sense that indeed retail sales will go up. And we see that going into the last two recessions. There was this boost in confidence. And then, of course, we note that retail sales either maintained or rose. Now we're facing the same situation as confidence is rising. This could give a huge boost to retail sales. The problem is, look at what happened afterwards. And all of a sudden, confidence came crumbling down. Retail sales fell with it. Now the question is, what is the likely outcome? Are we going to achieve that mythical soft landing? Because if we were, the Biden administration would not be panicking. There's something they know that perhaps not even the Fed realizes. And with confidence rebounding and inflation expectations falling, this is another sign the economy is on track for a soft landing. This from the deputy chief economist at Capital Economics. Of course, maybe it means that, maybe not, because when we look again at consumer sentiment in blue, this time we're going to overlay the consumer price index in red, but you might notice that looks a little off. Well, it is, because it's inverted here. And notice the relationship between consumer confidence and inflation. It tends to be that when inflation is low, consumers are more confident. Again, this is all about their wage staying ahead of inflation, giving people hope that they can go out and spend, that they can even borrow money down the road for things they want today, and know they can make those payments. The problem starts to surface is, what if people aren't able to make those payments at all? And now we start to get a picture of what the White House is seeing. As the consumer sentiment survey showed, the pickup in optimism was broad, with improvements across age, income, and political affiliation. In fact, more than half of households expect their incomes to grow at least as fast as inflation, the highest share since mid-2021. And now we're starting to get underneath here, because when we talk about confidence, people don't believe that we're actually going to go into a recession. There's no evidence of that to the broad consumer, so they're getting more confident. Inflation's coming down. The political elite said this was going to happen. Interest rates went up. The Fed did that. And well, it really hasn't had a major impact on the economy or the labor market. Well, not just yet, but when it does, we're going to see, of course, confidence come crumbling down. And consumers expect prices will climb at an annual rate of 2.9% over the next year, down from 3.1% expected a month earlier. They see costs rising 2.8% over the next 5 to 10 years, now a 4-month low, meaning they expect their wages to be keeping up with that. And of course, let's go look at total compensation here against consumer confidence, because there's something, again, that consumers do not understand, that when inflation comes down, that means their employer does not have the ability to continue to give them raises. This is the problem. Or if they do continue to get raises, they're not going to be enough. And that is the other challenge here, is as demand falls, what tends to happen is people lose their jobs. And here's what consumers really can't see as we look again at the University of Michigan Consumer Sentiment Survey, now overlaid with total compensation. This showed as average hourly earnings multiplied by average weekly hours of production and non-supervisory employees, that in red on a year-over-year rate of change. And so we can note, going into the dot-com bubble, there was a pullback in confidence, and then all of a sudden you see a surge. Confidence rose to new highs, and what happened is total compensation didn't go with it, and next thing you know, consumer confidence comes tumbling down. You see the same thing going into the global financial crisis, where consumers said, hey, you know what? The worst is behind us. Their confidence went up as inflation was kind of dying off there. And next thing you know, total compensation continued to fall as inflation came crashing down. Now we see the same effect. Again, confidence rising, giving everybody the perspective that the consumer is going to go out and spend. The problem is, their total compensation is falling, meaning they just don't have the money to keep spending at all. And consumers' perception of their current financial situation rose to a 2-year high, again, as wages now are surpassing inflation, giving, of course, the White House a much granted relief from this inflationary pressure that the Biden administration has been gripped with. And while expectations for future finances climbed to the highest since 2021, buying conditions for durable goods also rose to a nearly 3-year high, again suggesting that the soft landing is actually here, my friends, that we've achieved it, that the Fed has done exactly what they said they were going to do. But if you're in an eye of a hurricane, well, you'll note that everything gets peaceful, it gets calm. That storm before is a problem. Well, so is the storm after. In this case, we've got a big storm coming, and the U.S. consumer can't see it, but the White House can. And few more respondents also reported hearing considerably more favorable economic news. Of course, mainstream media promoting what the Biden administration asked them to do, as sentiment readings for both Democrat and Republican respondents in the survey showed the most favorable readings since 2021. Dissatisfaction with inflation and the broader economy has weighed on President Joe Biden's approval ratings, which of course is one of the reasons he's in panic mode, suggesting that he's doing everything he can to fix this, and he's going to extreme measures. And while, again, the U.S. consumer says things are looking good, the White House says they're not. Now, if you're looking to play this and make some money on it, you could chase the equity markets here in the U.S. as they go higher. But if demand from the U.S. economy picks up, well, what does that mean? Demand from the world's largest exporter, that's China, is also going to pick up. And if you look at Chinese equities, well, they're near some of their very recent lows. In fact, the last time they were down this level, they rallied over 50% in 3 months, giving you the opportunity to take advantage of this. But if you said, Steve, I don't know, I love this, I want to trade this, I want to be in this, I want to make some money on this move, how do I do it? How do I know when to buy? Well, if you had our CTA Timer Pro report, this looks at how the machines are positioned, which move the markets in a big way. We'll have an update on all this broadly speaking on Sunday's show tomorrow, but they're at max short because we run a historical overlay and we see this move to the downside is out of line. And when this starts to short cover, that gives you a signal. You could also pair it with our Momentum Timer Pro report, which looks at all those tactical signals that many people try to trade, like the MACD and the RSI and many of those other popular metrics, and we smooth that all out. And right now we can note the momentum has been trending down in a big way and is still falling. When we see a reversal here and this -7 turns to a +1 and we see that machine positioning jump, that gives you the signal. Now, talked to the programmer the other day. He's trying to make sure we get that by the deadline at the end of the month. We're doing some back-end changes to make these reports so much easier to use, as many of you asked for. And right now you can get in before that happens, start trading. There are 3 coupon codes for a free month. Links in the description. Grab them before they're gone. Because one thing that's going away, well, is some student loans, as most Americans who fail to pay student loans say they can't afford to keep up. And so I wanted to start out the show saying, look, the U.S. consumer thinks things are great. And if things were so good and getting better, then why can't people pay their bills? This should be a big issue. This is something the Fed won't see because they're going to fixate on the survey and other data points. But this is exactly what the White House sees. And when people can't pay their bills, now that means they're going to cut spending elsewhere. And of course, if you start to cut your spending on the discretionary side, there's a problem. Leads to more job losses. And more than half of Americans who failed to pay their student loan bill since October's restart said the main reason was payments were unaffordable. Again, this should not be happening if the economy is turning around. They should be saying, well, wait a minute, you know what? I struggle with this first payment, but I'm really optimistic. The economy's turning around. Things are looking brighter. This shouldn't be a problem. The problem is, it's getting worse. As the study comes down, as the Biden administration seeks new ways to write down student loans or make repayments manageable after its wider debt forgiveness plan was struck down by the Supreme Court. So you think of this as somewhat of a tax break, except a different one. You wipe people's debt out, and all of a sudden, what does it start to unleash? The potential for them to continue to spend on the discretionary side of the economy. You get the mythical soft landing. You get reelected because we're not in a recession. It makes perfect sense of why the Biden administration is so eager and so desperate to do this. You would not get this based on the surveys where you see, of course, U.S. consumers are starting to grow in their confidence. White House, meanwhile, in total panic mode, because if these payments continue and people still have to make them, and again, it means spending on the discretionary side goes down, and as you'll see, that means hours work drop, that means unemployment goes up, and by the time we get to the elections, there's a really good chance we'll be in a recession. And some 22% of borrowers anticipated failing to make at least one of their scheduled payments, which at the surface might not be a big deal. The problem is about half of that group is saying they'd miss all 3. And again, this is exactly what the White House is looking at, is if the economy is turning around, why can't these people make their debt payments? If they can't make them, the economy underneath is far worse off for some Americans than it is for those responding to the survey. And you've got to get these people relief as quickly as possible, any way as possible, to avert this recession, because this data says there's virtually now no chance. If we get into a recession, the President Biden will be back. And we can look at the evidence here. Of course, consumers are getting more confident, but one thing that's really not responding in a big way is average weekly hours worked. Of course, we noticed during the holiday season that went up, which makes sense. And we'll be watching this carefully in the months to come, because if hours worked decline, and you note the relationship here with consumer sentiment is pretty tight, that as demand goes down for labor, confidence eventually gives up. And if we see this hours worked roll over and head down, well, that means American consumers got ahead of themselves, and at a time when they have massive amounts of debt. Because if they can't see what they don't understand, this is all about the money system in our economy. If there isn't enough money being created to pay on all this debt, which is evidenced by the fact that people are not able to make their student loan payments and projecting they're going to be unable to make it, well, of course, the government needs to step in, give them relief, put them on top of the deficit that everyone's already got a problem with to begin with, saying the deficit's too big, it's going to keep interest rates too high. And if that keeps interest rates high, well, that means the Fed's also going to keep interest rates elevated, means the banks don't lend, they don't create new money. And sure enough, when we now overlay the net percentage of domestic banks tightening standards for commercial and industrial loans to firms of all sizes, as we see here in red, with them tightening over that horizontal green line, what do you know? Confidence comes tumbling down each time. Why? Because that transitory bounce in confidence that the economy was rebounding was met by a wall that says there isn't enough money to sustain your optimism or growth. And sure enough, that's what we're facing right now. There's a boost in, of course, what we note as confidence in the preliminary survey here shown in the official data that's only updated once a month. And what that means is the chances that this is going to turn around because the banks aren't creating money is super low. And as a result, Biden administration now cancels $5 billion in student loan debt in the latest relief step. As we can note, this is probably the first step and more to come, trying to give as many Americans a break so they can get out there and spend and do what Americans do, is buy things today with money they don't have, and that gets the economy growing. As my administration is able to deliver relief to these borrowers and millions more because of fixes we made to the broken student loan programs that were preventing borrowers from getting relief that they were entitled to under law. And of those receiving assistance, nearly 44,000 are public servants and nearly 30,000 are enrolled in income-driven repayment plans. So far what we see here is just the government making good on its promises, but we know the Biden administration wants a whole lot more and fast, because this plan was slated to be much narrower than the original plan that would have forgiven as much as $20,000 in student loans for an estimated 40 million Americans. You imagine such a tax break, which is what you have to kind of look at this as, targeted to certain Americans, frees up their income. That means they go out and spend. You put it on the government's balance sheet, the economy grows. If you could cut the deficit, and I know they can't, they desperately need to, then maybe everything balances out. The problem is we're going to face a large deficit into a recession, and there's going to be calls for the government to cut their spending at the worst possible time. And what this, of course, means if we see confidence continue to fall, well, that means spending goes down, and with that, we note that continued claims rise. In fact, continued claims is one of the drivers that confidence comes down. We can see that consumers get more confident here going in the dot-com bubble, but problem is continued claims go up, and boy, that upends that in a big way. Same thing here going to global financial crisis, almost true here going into the recession in the early 1990s, and now we see the same thing, continued claims elevated. Now the question is, do you believe the official numbers or the non-seasonally adjusted numbers? Well, if you like the non-seasonally adjusted numbers, you're up to 2.1 million. On the other side, according to the government, you're down to 1.81 million. Still enough people to slow the economy down. And believe me, Congress is aware of this too. As a new $78 billion business and child tax break bill advances in the U.S. House, as politicians of all kinds are looking to get reelected because they're worried as well the economy goes in recession because they can't get the Fed to change their mind. As the House Tax Writing Committee approved the compromise bill with a strongly bipartisan 40-3 vote. Let's put some more money in the deficit here because House and Senate Republican leaders have been silent on the tax cuts. Even as President Joe Biden embraced the compromise after the vote, and of course he would. Anything he can do to give people a break, to spend money, to drive the equity market higher, to get the unemployment claims down, to give them debt relief means he's got every chance of getting reelected. Problem is, he doesn't have much time. And what we can note here is the White House press secretary called the measure a welcome step forward that we believe Congress would pass it. You bet they'd believe it. Because we can see here that the yield curve will remain supreme, again, when the Fed keeps rates elevated, which you think about this, if we get this big tax break, wouldn't it lead to more inflation, keep the Fed with rates higher for longer, keep the curve inverted for longer, keep the banks from creating money for longer? Well, again, if there's not enough money to sustain the economy, confidence eventually comes crashing down. As we can note, the curve inversions are usually, at least we can go back to the 80s, where at the same time time came with lack of confidence. Going as we move into the late 80s into a more global economy, curve inversions followed a crash of confidence every single time. The pandemic being an outlier because we just don't have the data to say what would happen if there wasn't a pandemic. But this time we can know that that inverted yield curve, those inverted money curves are telling us that this confidence by the consumer is indeed transitory. And based on what's going on, we're not going to see anything from the Fed or any other central banker give up any pressure. And this is something, again, the White House would love for the Fed to cut rates going into the election, give them any headwind they can. But looking at these headlines, Fed's Daily warns it would be premature to think rate cuts are around the corner, suggesting nothing in the first half or in time for the election. How about this? Fed to begin rate cut discussions this coming at the end of January, but avoid teeing the first one up. It's all talk and no action, which again, Biden administration desperately needs here, as policymakers have reluctantly suggested they're ready to begin discussing the broad parameters for lowering rates after giving the subject only a passing nod at their last meeting in December. Several have indicated a willingness to entertain rate cuts in the first half if inflation falls faster than expected. Of course, many of them don't believe it will. We know that's likely to happen here at some point as demand gets eviscerated from the economy, suggesting that we are indeed trying to head down. But around the world, what do we see? Key African economies to hold off from rate cuts until second half. Even the ECB is looking to pick the right moment for the first rate cut, according to economists, suggesting that everywhere we look around the world, that President Biden is going to get no help from any central banker until it's too late. And now you understand why the Biden administration is in panic, why Congress is in panic. They think we're heading into a recession. We know we are, but the U.S. consumer just hasn't figured it out yet. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.